Hey friends, I'm back. I have another value stock that I want to share today that I am buying right now in my personal dividend stock portfolio. This stock yields 4.91%. It's trading at a forward PE in the 13s. It's trading at a value level. And it's trading at a value level for good reason. The company is facing some challenges, but my own personal analysis shows for my personal situation that I believe the dividend will continue to be safe and solid, for the time being at least. I'm talking about a company that some of you have been asking about. It's General Mills. They make this Annie's mac and cheese, as you can see right here. This stuff's pretty good, by the way. But General Mills, it's another CPG food stock. And so for some perspective, this stock is only 0.5% of my portfolio. It plays a supporting ancillary role, but it all adds up. I like having stocks like this that yield more than my portfolio average of about 3.71% because I'm on my home stretch here as I reach my financial goals in terms of dividend cash flow. That 4.91% starting yield that I believe is safe is meaningful to me because it's qualified, it pays bills right away. It gets me to my cash flow goals quicker. But of course, this is an ancillary position. By the way, in my last video, I shared some other value stocks that I'm buying right now as well. I'll link to that in the pinned comment below. But here's the deal. My YouTube channel, what's unique about it is I don't just share stocks. I'm going to go through this one in detail today, but I also want to impart to you some OG wisdom because I've been in this game a long time. And I've got some stuff on my mind that relates to this situation, but stock market investing in general. I want to go back and share with you when I started working, I worked a variety of jobs in my early days in digital marketing. And back then, I had a strategy. I would endure my way to success. And what does that mean? I worked at companies that were very challenging. These were companies that expected a lot of their employees. Long hours, difficult goals, very stressful at times. But what I would do is I would go in, I would work my hardest, I would do my best, and I would outlast everyone else. Slowly but surely over the years, people oftentimes, they just couldn't even keep up with the challenges of the work environment and they'd kind of drop out. But I was still there. I would endure my way to success. And by enduring my way to success long enough, I had huge opportunities. My hard work was rewarded. I got promotions. I got more people to manage. I got more job responsibility. I made more money that I could invest in dividend stocks. And so there was this element that I've always had in my strategy for work and investing of loyalty. And loyalty not only in the best of times, but also in those difficult times. I would endure some challenges that a lot of other people, they didn't have the grit to make it through. Some others did, of course. I'm not the only one. But the reason I'm sharing that is I see in the marketplace right now in the discussion online about dividend stocks that there's a lot of people that are bailing. They're selling stocks. They're selling at the first sign of distress, of challenge. And let me tell you something. This is very important because I'm talking lately about stocks that have fundamental problems. Right now, General Mills, they're facing some margin problems. They're facing some revenue problems, but I see it more on the margin. Their SG&A expenses are way up, margins are down. They're facing some margin problems. Dividend is still covered just fine. I look at the cash flows in this video later, you'll see it's covered just fine, kind of like Campbell's soup. But what I'm seeing right now is investors are bailing when they believe there's a fundamental problem. Let me tell you something. I've been in this game a long time and I've been very successful at it. Many of you have been following my journey since the early days. Shout out to all the OGs. If you're new here, please don't forget to subscribe. I've got a lot of cool videos all the time. But what I want to share with you is just another example. McDonald's, a stock I own, one of the largest positions in my portfolio. I share some of my top positions over on Blossom. Check out the pinned comment below. You can sign up for Blossom. It's free to get started and you can see some of the largest positions in my portfolio over there. In terms of full disclosure, I'm an affiliate of Blossom and I'm compensated for signups. I'm also long Blossom. I'm going to talk more about Blossom later. But anyways, I share McDonald's over there. One of the best performing stocks in my portfolio, largest core stocks, best performing stocks for any investor around the world. What a great company. But if you go back in time between 1999 and 2007, McDonald's stock went nowhere. Those were some challenging years for McDonald's. McDonald's back in those days had some challenges. What if you had invested, or I had invested in McDonald's back then, and then I just sold it because there was some turmoil, there was some fundamental challenges? Well, I would be really regretful of that decision right now in the present day, because McDonald's has done so extremely well. What I like to do is find the best companies in the world and remain loyal to them. Now, let me not kid myself. General Mills is no McDonald's. It's an ancillary stock. But that being said, I'm not selling here. I'm buying more. I like to buy companies that I believe in when they're in distress. And here's kind of the related point to all of this. Any company an investor owns long enough will have fundamental problems. Let me repeat this. Fundamentally, companies that you own right now or I own, at some point in the future, most likely, they will face fundamental problems and issues. And there's this prevailing belief right now in the investing community that it's important to sell a stock when the fundamentals change. Here's what I want to say today. If the fundamentals deteriorate so bad that the stock will have to suspend the dividend permanently, if the fundamentals deteriorate so bad that there is never any hope in the future that the company will come back to its former place, in those situations, look, I like to sell. I rarely sell, but that's a good reason. But if there are some fundamental challenges like McDonald's faced back between 1999 and 2007, I'm willing to wait it out for 8 years. I'm willing to wait it out for 10 years. I'm willing to wait it out, honestly, for 15 years. I have that loyalty in life and in my investing, and it works in my personal situation. Now, I'm not offering any kind of investment advice. I'm just sharing my personal journey here on YouTube, as always, for fun and entertainment. And I have all my disclosures, disclaimers in the description below. But what I want to share with all of you is when a company has fundamental challenges, I don't bail unless they're irreversible. If there is a setback like General Mills or Campbell's Soup is facing right now, I like to add, and I like to take calculated, measured risk in my portfolio because there's upside buying when things are not so good. Also, if I don't even want to buy more, when fundamentals are going through a period of transition, they're not as good, but they have promise of coming back, I'll just reinvest dividends, I'll hold strong, I'll do all of that to allow the dividend snowball to compound over time, because the most valuable asset all of us have as dividend investors is the time. It's the time and the compounding. And we interrupt that compounding when we sell, when the fundamentals, yeah, they're kind of not so good, but they could recover. And rather than selling, I like to buy in a lot of these cases. So just a reminder to all of you out there from someone who's been in the game a very long time, for anything we own, the fundamentals, they're going to be bad. They're going to be bad at certain points. Business growth is not linear. It has ups and downs, and it takes long periods of time to build true value. Anyway, let's talk about it. As you can see on the screen today, I want to share side by side General Mills and Campbell's Soup in terms of some perspective. These are both 0.5% of my portfolio. They're ancillary supporting positions. I don't want anyone to think otherwise, but I am adding slowly to both of these right now. And over on Patreon, on my backyard and corner tiers, which I will link to in the pinned comment below, I share my trades. On corner Patreon, I share my portfolio, percentage allocation to each position. So General Mills is down 35% almost from its 52-week high based on the forward estimates for fiscal 26, fiscal 27. The forward PE is in the 13s. What I like about General Mills here is they are declining in 26 versus fiscal 25, but analysts see them rebuilding in 27. I'm not going to spend any time really on Campbell's Soup today, but I have it on the right-hand side of the screen as a comparison. By contrast, Campbell's Soup, if you look at 25 versus 26, analysts see that the EPS will continue to decline. So I believe right now the analysts are thinking that General Mills will turn things around quicker. That's why General Mills, honestly, is trading at a higher starting PE. General Mills right now offers a starting yield of 4.91, which is a little bit higher than Campbell's Soup's 4.81. Payout ratio is higher at 66.7% versus Campbell's 53%, but I believe those payout ratios are respectable, they're sustainable. I believe the dividend is safe for now at both companies. I will go into the statement of cash flows later on General Mills to show you deeper why I believe that the dividend is safe for now. They are growing the dividend. They just increased it by 2%, and on the last 5 years on average, it's up 4.5% per year. The fact that they just increased the dividend by 2% gives me further confidence in their ability to maintain and probably grow slowly the dividend over time. General Mills is a bigger company at $26.56 billion market cap. So it's bigger. It's more than double the size of Campbell's Soup. And so those are the high-level metrics on General Mills. But what I want to do next is I want to go into some of the further details from their recent earnings report. As you can see on the screen in front of you right now, let's just look at the high level. Why is this stock down so much? Why is it down 35%? Well, at a high level, their fourth quarter for fiscal 25 was really bad. The full year was okay. You can see diluted EPS was down 5% and adjusted diluted was down 7%. That was for the full year. Not so bad. But fourth quarter, the problems accelerated. You can see diluted EPS in the fourth quarter was down 46%, adjusted diluted down 27% in the fourth quarter on constant currency. And so they have some challenges, and the challenges are getting exacerbated in the fourth quarter. Hence, investors are selling. Hence, the stock is cheap. Hence, they have a fundamental problem right now, but I believe over time that they will be able to improve upon these problems. And I believe even if they don't, the dividend, as long as they can hold the line, I believe it's safe. And that's really why I'm investing in this right now as a bond-like proxy, qualified dividend, nearly 5% with some level of growth. But I want to keep going. As you can see on the screen in front of you right now, check it out. There are a few financial statements I want to go through today. The first one is the balance sheet. The thing I want to point out on the balance sheet is on the assets side of things, it looks pretty strong at $33 billion, but we must keep in account that Goodwill is $15.6 billion and other intangibles are $7 billion. So a good percentage of the assets are intangibles, and Goodwill is reflective of them paying over book value for acquisitions they've made, including probably that Annie's mac and cheese. Now, on the liabilities side of thing, what I don't like seeing there is the long-term debt. It is growing. It's up from $11 billion to $12.673 in the May 2025 unaudited column. And so long-term debt is up and it's increasing over time. I don't like seeing that in an environment where they have to pay their dividend, they're shrinking in terms of adjusted diluted EPS, and the cost of capital and servicing debt, it's high. At some point, rates may go down, but for now, rates are pretty much in a steady state, and the cost of capital is pretty high. And so that must be factored into everything. But I want to really dive in now to the statement of cash flows. As you can see on the screen, this is very important. When I buy an ancillary high-yielding position like General Mills, the main thing I want to see is can they continue to pay my dividend? And so what you can see on the statement of cash flows, you can see that they have their operating cash flows. And their operating cash flows for the fiscal year ended 2025 are $2.918 billion. And now that's down from 3.3 in 2024. But still a lot of cash provided by operating activities. Now let's look at dividends. How big are dividends? Well, you can see it's 1.338 billion. And that's actually down from the year ago because they've probably done some repurchases. And so dividends as a ratio of operating cash flow are pretty small. And I like that because it shows to me that the dividend, for now at least, is sustainable. But also on the screen in front of you right now, what you can see all the way at the bottom is cash and cash equivalents at the end of the year. Now you can see cash and cash equivalents at the end of the year more or less is steady. And so overall, I believe that they're managing their cash flows well during this difficult time that they're facing. But I want to look at a few metrics. Check it out on the screen. I'm going back to that table I shared before, and I have a few financial metrics here I want to share with all of you. So the first one that I want to share is just on the balance sheet. They got assets of 33 billion, but let's see, Goodwill and Intangibles are 22.7 billion of that. What's that ratio? Well, 68.7% of their assets are goodwill and intangibles. By contrast, Campbell's is at 63%, so I like Campbell's a little bit better on that front. Also at the bottom of the screen, you can see long-term debt. Let's look at long-term debt. It's 12.673 billion for General Mills, 6.097 billion for Campbell's. If I just take their long-term debt to operating cash flow, I'm getting a multiplier of 4.34 for General Mills, 5.24 for Campbell's. So whereas Campbell's was winning on some other metrics, General Mills is winning on this metric. They're managing the debt just a little bit better than Campbell's, although I'd like to see both of them pay down their debt. Now, one thing I would say is I like that Campbell's debt is down year over year, whereas General Mills is up. Now, also on the bottom of the screen, you can see cash flows, and I want to look at their operating cash flow versus dividends. Basically, for General Mills, they have 46% of their operating cash flow is going to dividends. Campbell's 39%. So Campbell's is a little stronger on this front. But overall, I believe at both companies for right now, at the time being, that the dividends for both are sustainable. And that's why I'm buying. I'm buying these stocks in very small increments because they offer high, nearly 5% starting yields on a qualified basis, and I believe the dividends will continue to grow slowly over time. I'm talking 1-2% per year, and I believe the dividend is sustainable for now. But let me summarize the video today. Just another value stock in the mix. It's never going to be my biggest stock, but it plays a role in the team, as you can see on the screen in front of you right now. Check it out. Just a quick summary. So summary one, if you hold long enough, fundamentals at some point or another, they will be bad. We have example of McDonald's I shared. Microsoft is another fabulous example. Think of all the investors that sold between 2000 and 2015 where Microsoft did nothing. They are probably really regretting that right now, as are the McDonald's shareholders who sold between 99 and 2007. I want to offer the perspective that these types of positions, they play a role, but they're supporting. I'm closer to my goals, and that's why I'm looking at some of these higher yielders. They will always be ancillary. As of now, I believe the dividends are safe, but just my personal opinion for fun and entertainment. They both just increase their dividends, and we all need to eat. Look, there's inflation, there's tariffs, there's weight loss drugs. Consumer preferences may be changing. Nonetheless, everyone needs to eat. I take notice of holdings that drop substantially and quickly. I look for value. Is value investing over? Are dividend stocks over? I don't think so. And honestly, I don't really care about share price. I care about yield, sustainability of yield, opportunity to grow yield over time. Now, obviously, these are higher yielders at slower growth. I have other positions in my portfolio that are growing the dividend much quicker, but have lower starting yields. They all play a role in the portfolio. I average them all out. Now, everyone, if you enjoyed the video, please don't forget to click the like button. And also, I want to share with you, I have some major exciting announcements to make. I will be speaking live. You can meet me in person at the Blossom Investor Tour in both Toronto, that will be in September, and in Chicago, that will be in October of this year. If you want to sign up for those events, check out the pinned comment below. I have a link to more details about them. And I also have my code in the link below that you can get 15% off, the PPCEN code. I am so excited because I'm going to be speaking on the stage at the Blossom Investor Tours. I'm going to be sharing my love, my passion for dividend stock investing, and there will be plenty of photo opportunities to network. I hope to grab a photo and say hi to those of you that can make it. Toronto is in September. Chicago is in October. Put in the comments section below if you plan on attending the events. And again, in the pinned comment below, I'll have my links. Before I go today, in terms of full disclosure, I am long the stocks mentioned today. I am long General Mills, ticker GIS. I am long the Campbell's Company, ticker CPB. I am also long McDonald's, ticker MCD. I'm also long Blossom. Also, in terms of full disclosure, disclaimer, I am an affiliate of Blossom. While it's free to sign up for the app, I am compensated for signups, and also I'm long Blossom. Also, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. I'm just sharing my personal journey on YouTube for fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market. As always, I have all my disclaimers in the description below. I love you all. I appreciate all of you watching my video today. I can't wait to see you in the comments below. Let me know if you can make it to Toronto and or Chicago. Let me know what you think about General Mills. A lot of you asked for the video. That's one of the reasons I did it today, but also I did it because I appreciate all of you for sharing with me how much this stock had dropped in the last year. All right, everyone, I'll see you in the comments below, and I'll see you in the next dividend stock investing video.